Okay. Good afternoon, everybody. Glad to have you back for our afternoon, which is full of exciting material. My name is Florian Heider. I'm the scientific director of the Leibniz Institute for Financial Research, SAFE. We are one of the co-hosts of today's conference. And without further ado, I'm going to introduce Ndidi, Nnoli, Edozien, board member of the ISSB, who is going to lead us through our two academic panels.
And I'm going to introduce immediately Professor Reichelstein, who's going to open, who's just walking up to the front. And what we're going to try and do today is we have two very exciting panels, one of them about carbon accounting, and the second one about biodiversity, the corporate biodiversity footprint. We're going to be led by two papers, 45 minutes, and we're very short on time. And then we're going to have a discussant. In this instance, it's going to be Dr. Verbücheln and Professor Barker, my colleague. So without further ado, over to you.
Thank you. I guess I would get up and possibly to the podium. It would help to have the slides. Okay, let me get started without the slides. First of all, pleasure to be here and to give this talk, which is basically going to be a summary, the highlights of this working paper, which is very soon going to be published in the Review of Accounting Studies. Listening to the sessions this morning, I think it has become fashionable that with every document one says how long the paper is. So 48 pages, I'm happy to submit. I was a little bit reminded of the old Woody Allen movie. I like to think of this paper as what you always wanted to know about carbon accounting, but may have been afraid to ask. As you may recall, Woody Allen said this about something different than what I'm just talking about here. So this is, as the title suggests, it's really about the notion, to what extent can we push financial and managerial accounting, the way we know it, understand it, and have practiced it for a long time, into the domain of carbon accounting. So the motivation, I think, is relatively straightforward. And that's sort of one theme for the whole 20 minutes that I have here. The second theme is going to be the whole issue, how far are companies along on this path? That's will take a little longer to explain, but I do want to submit and want to sort of put this out as a record early on. There are a number of companies that have really implemented several of the steps that I'm discussing here. And it's a work in progress at these individual companies. And if possible, the discussions kind of can get us a little closer to that. Those are also described in the appendix of the paper. Okay, let me start with a chart that all of you have seen many times, the greenhouse gas protocol. And since I'm limited in time, I'm also going to sort of go straight to the issues that I see with the greenhouse gas protocol and the way I've heard it from many conversations in corporations over the last few years. The first proposition is the greenhouse gas protocol, in my mind, is not a carbon accounting system. It's a classification system. It asks you to report along certain categories, but it does not have the features that we traditionally associate with an accrual accounting system. And in my mind, the biggest sort of indicator of that is that the greenhouse gas protocol, in my mind, does not do a proper distinction between stock and flow variables. These things sort of get mixed up. We also know that in terms of companies doing this, thus far in most parts of the world voluntarily, the implementation of the greenhouse gas protocol is uneven and it is also inconsistent. On that, we have actually since this is a session about research, on this we have seen quite a bit of studies that have looked at different industries and the implementations thereof. The final sort of concern that really leads me and my colleagues sort of to go in this direction here is the whole notion of incentives. What is this ultimately all about? It's about carbon management and reducing emissions. And any reporting framework that is useful from that perspective must provide appropriate incentives. But as long as most companies rely the way they do right now, largely on secondary data, where outside consultants essentially tell them, these are the production activities you have undertaken, these are the emissions associated with that, and those we get from databases, as opposed to this is what actually happened in your company and in your whole supply chain. As long as that is not properly matched, the incentives to make costly investments and reduce your emissions are going to be missing. So that's sort of the starting point for this whole work. This is a slide that for this audience I can skip because you all know this at least as well as I do. What do we have sort of on the mandatory carbon reporting side? It has evolved in recent years, and I'm finishing sort of there on the last point with what you may argue is the most expansive and the most demanding reporting standards here by ESRS on the full scope 1 through 3. The US obviously hasn't taken that step with the recent announcements by the SEC, and generally, I would say other jurisdictions are even further behind. Reporting mandates are one angle in all of this. What has actually motivated us a lot more in this is the whole movement that we have seen in recent years where companies voluntarily state goals about decarbonization, and they also then sort of take the next step of saying, well, how are we going to make good on the promise that we issued? How do we credibly report on an ongoing basis that we meant it when we said we would be in a net zero position by 2050? And these reports sort of increasingly engulf sort of two dimensions. One is the notion, what is this company's overall carbon footprint? I'll refer to this as the CCF, the corporate carbon footprint. And at the same time, we're seeing increasingly companies going into the domain of saying, here are individual products that either are already carbon neutral or will be carbon neutral in a number of years. And as we all know, this is something that companies want to do, but the principal issue in my mind is that the credibility of these disclosures is still missing, partly because we don't have really a framework. I refer to it here at the bottom as generally accepted carbon accounting principles that companies rally around, and everybody could say, we have prepared our statements in accordance with these principles. And furthermore, they have been audited, just like your financial statements have been. If we had that, I think this notion of companies being able to differentiate themselves and saying, we really mean it and we're delivering, as opposed to the normal greenwashing, everybody wants to be green and do something good in terms of their disclosures. If that becomes more credible and differentiated, I think it would make a tremendous difference. So let me give you a little bit of an overview, and it can really only be an overview in the time that we have, but the discussants, I'm sure, are going to pull it apart a little later anyhow. So the idea, stick with both financial and managerial, in particular cost accounting, as far as you can. Truth be told, I won't be able to do this all the way. There are certain items where we will need to be a little more creative and sort of have to think in ways that financial accounting does not tell us. But I maintain it gets us a long way towards the goals that are articulated. So first of all, it is a double entry bookkeeping and accounting system. It results annually in the equivalent of a balance sheet. I mean, this is one of my other sort of peeves about the European and German discussion. In Germany, everybody talks about a Klimabilanz. Well, let me ask you, have you ever seen a Klimabilanz? I have not. Can we really get something like this with credits and debits? Yeah. It should really be possible to prepare such a thing. The question only is according to which principles. And in addition to a climate balance sheet, could there be something like a flow statement, a measure of profit or loss for the current period? And what would that express? Okay, so these are the two things really that should come out of a system. What are we accounting for? Now I'm going back sort of to the broader categorizations of the greenhouse gas protocol. So you will see it basically goes the direction of scope 1, 2, and upstream 3. In other words, everything that's in your supply chain. You will then ask, and we probably will have a discussion, why not downstream scope 3? My short answer is because that's not measurable generally. That is in the future. It's estimable, but it's not measurable. Since this is an accounting framework, we should principally stick to things that we can measure, where we're basically, like in historical cost accounting, sticking with the things that have happened and been verified at different stages in the supply chain. Okay, so here is, and this may be sort of a little too fast, but I'll just flash it out. The paper is available. What such a climate balance sheet would look like. Roughly think of it as, on the asset side, carbon emissions in assets. So these are the upstream scope 3 emissions in your inventories, in your operating assets, but also in your work in process and finished goods. And to the extent that those emissions are reported in there, they would include the company's own direct emissions, its own scope 1 emissions. What do you have on the liability side? Well, two things to point out to. One is direct emissions. So this is your scope 1 emissions. And the possibility, and that's why there are little parentheses around there. Parentheses around there indicate a negative sign. These are negative emissions that the company itself commissions. Those, I think, in the whole debate about climate change are going to be vastly more important in the future than now, because ultimately, the only thing that I think the world has a chance for is to get to a net zero position. And a net zero position means we're still going to be left with some gross emissions, which then have to be offset by some removals. And finally, the point, again, in analogy to a standard, a financial statement. What's equity here? Equity is basically cumulative retained earnings, except earnings here is a measure of damage in this, the damage that you have done in past years. And there are some companies, in particular the technology firms in the US, like Google and Microsoft, who have sort of been working with this concept and saying, we have a notion of what our legacy emissions are. This is sort of the damage we have ever done ever since this company, this business came into existence. And one of our goals is that we will be able to undo all those emissions in the future, or in the case of Google, and perhaps we can talk about this later on in the discussion, Google says, oh, by the way, we have already eliminated all our legacy emissions. We have been carbon positive for the last 5 or 6 years. And it's an interesting question, what accounting game you play if you make such a play work. Yeah. So what's sort of the nuts and the bolts of the system is this so-called cradle to gate product carbon footprints. So that's a way to assign, once again, scope 3 emissions to the products and services that the company sells and delivers. I'll speak sort of products, think of physical products, but this would apply equally, say, to a service business, be it a transportation business or an airline. Yeah, so it doesn't have to be a physical product. Cradle to gate suggests we're tracking, or others are tracking possibly, the emissions, the direct emissions at every step along the supply chain. And in doing so, they all built their own product carbon footprint measurement system. And since this is, I presume, largely an audience of accountants, all you have to think about is a cost accounting system. So it's really a cost accounting system in the sense that we have the cost of our production inputs, we have our own cash expenses that are being added to it. These are our own scope 1 emissions, possibly some removals, but the all-important part is now the emissions in acquired inputs, be those consumable goods or assets. Those we're also adding in the tradition of a normal accrual accounting system to determine the cost of an individual product, and then in the financial statement, ultimately, the cost of goods sold. So think of this as a mapping, as you see there, which I denote by little f, that maps things ultimately into outputs, and outputs are either in inventory, finished goods inventory, or if goods are also being sold, it then moves off the balance sheet into the income statement as part of goods sold. This is, of course, in principle, relatively simple, but here is where things get a little trickier. There are going to be, in most organizations, lots of overhead emissions, just like we have overhead costs in cost accounting. Your scope 1 emissions, in other words, what goes out the chimney at your production sites, is the nature of an overhead emission that needs to be allocated, needs to be assigned. Same typically in most organizations at the plant level, say the emissions associated with the electricity and heat, the energy that you're consuming, that would also be such an overhead item. One thing that I found interesting here, mostly sort of in the European theater of operations, organizations worry about how should such systems be designed and how much discretion should companies have? Should it be the same discretion that you have, that a company has in structuring its own internal cost accounting system and then using those numbers to report as part of goods sold? So I mentioned here in particular Catena-X, which is an industry consortium around the automotive industry that has sort of started to write a rule book on what is a good and appropriate way to do these cradle-to-gate product carbon footprints. For the chemical industry, Together for Sustainability has done similar things, and there is some overlap, though not sort of perfect harmony yet between these two industry associations, setting out guidelines, or in the case of Catena-X, they speak of it exactly as explicitly as a rule book.
We're at the 20-minute mark.
Okay, I will really speed up now. So what do we get? We get 3 things: a recursive and decentralized measurement system for upscope 3. In principle, this should not entail double counting at the product level. It will always entail double counting at the company level. And the incentives part I already mentioned. Here now, since we're tracking actual emissions along the supply chain, the incentives for you to reduce your own emissions or lean on your suppliers to do the same thing are much different from what they were before. Carbon offsets, the negative emissions, in my mind, are the big soft underbelly of all of this. This is going to be huge. And here, of course, financial and managerial accounting no longer give me guidance. What is an admissible offset and how do we treat it? Lots of discussions about this, and I think we're just seeing the tip of the iceberg in terms of this really becoming more important in practice. Here's my income statement. Ultimately, it's carbon emissions in goods sold, CAGs, and it is really the measure of current damage done by to the global climate by the firm's sales products, and that then feeds into the balance sheet. And now I am really out of time. Here are just a couple of key performance indicators. Again, this is all about management and ultimately assessing the progress that a company is making. From the combination of this balance sheet and my CE flow statement, my carbon emissions flow statement, I get these metrics, and in my mind, these would be useful in assessing whether companies are really making good on the promises that they have issued voluntarily. I also think it will be compatible with what we're hearing so far from the standard setters. Whoops, I guess somebody's telling me it's really over. Here's my closing bell. We need generally accepted accounting principles. I think they're really coming into shape already. These types of carbon emission statements should be, in principle, accessible for auditors. The next big step is going to be enterprise software solutions that automate these transactions so that this is no longer done sort of in a spreadsheet, so to speak. If this happens, I think we will have gained quite a bit in terms of transparency. And ultimately, I keep coming back, better incentives to actually both issue promises and then follow through on those promises. Thank you.
That's an excellent way of putting 45 pages into a few sentences, and you did keep to time. Thank you very much. And I can think of no better person to kick this off. I think the only word that's missing on that closing slide was connectivity. And Richard, I think that you're a very good first discussant of this paper. So without further ado.
Thank you very much. So asking academics to keep to time is a challenging exercise. I'll see what I can do in 5 minutes. Let me first start with echoing a comment made by Veronica. Well, I can't see Veronica in the room, but earlier today, she said, we really enjoy the energy in Frankfurt. And I'd just like to endorse that comment. You can feel it in the room. We're delighted as an organization to be here. So firstly, a comment on the contribution of the paper. Two things to say. Firstly, for those who don't know the Review of Accounting Studies, this is a major journal. And so actually having a paper on sustainability reporting in a journal of that type is fantastic. It's pioneering. Other thing to say is what I really like is seeking to add rigor to thinking about scope 3, in particular applying costing, and in particular activity-based costing to thinking about how to allocate scope 3, making a distinction between measurement upstream and estimation downstream. I think we too often conflate scope 3 into one basket. And also thinking about a cumulative position on impact rather than just a periodic impact. Okay, that's the nice stuff out of the way. So let me now go on to some criticism of the paper, some comments. Very general locating comment is about the difference between rules in a GAAP sense and practice in a management accounting sense. So the paper starts with a statement, current corporate disclosure regarding carbon emissions lack generally accepted accounting rules. So the implication is we should have a sort of gap for carbon. Now, rules from an IFRS point of view that's not quite how we would think about GAAP. And the paper, in my mind, is mostly a management accounting paper. Rules are, rules are the things that constitute institutions. You can think of an institution as being a collection of members that all adhere to a particular set of rules. And in our particular world, in IFRS world, the member organizations, as it were, the organizations, the preparers, and the rules that they are adhering to are corporate reporting rules for the organization, not management accounting. So this work is very directly relevant to IFRS, but it's not GAAP in my view. But that's just a location issue. The more fundamental issues are around impact and dependency and the positioning of the paper and the use of accounting as a lens for thinking about carbon. So on page 20, again, the very important sort of summary statement, CEGS, I'm not sure how you say that.
Kegs.
Kegs, beer kegs, I like that. Is a cost measure of the current damage that products sold by the firm have contributed to the global climate. So I emphasize current, and I'll come back to that, but notice the focus is on impact. It's on the responsibility of the organization for its contribution to climate change. It therefore relates to a subset of S2. Now, S2 is concerned with sustainability-related risks and opportunities, and impact only insofar as they're relevant in that context. Now, also, I think, and critically, I think it's partly about impact and partly not. And I think accounting as a lens creates some challenges when thinking about impact. So the focus is on cradle to gate. It's not total impact. It's about the impact up until the factory gate. And that's a natural way that financial accounting kind of encourages you to think. But in many industries, downstream impact is where the impact really is. If you think about mining or the auto industry or makers of jet engines or something, impact is mostly a downstream issue. And it's not necessarily difficult to measure. If you're in the oil and gas industry, impact is sold in barrels, right? It's actually very, very directly measurable. So, so impact is only partially captured by the paper. It doesn't mean to say that the focus is not unimportant. It just means it's partial. Second thing, perhaps more important from an impact on the environment perspective, is an issue of timing. So when when a process, an upstream process, emits emissions, they go straight into the climate at the point of the emission. They don't get amortized over time. But the accounting method and thinking about capitalizing into inventory, or in particular capitalizing into property, plant, and equipment, allows you to think that the impact somehow can be allocated into the future. Now, so imagine building a building, there's lots of concrete in the building. You'll still be allocating the emission 50 years after it was actually emitted. A related issue is the use of the double entry structure to allow a netting, to allow reductions to be offset against gross emissions in developing a product footprint. I think that's problematic. So one of the things that I would say, learned from engaging with the ESRS process, engaging with the EFRAG team, was the ESRS has a very clear focus on reductions. Our focus was on tell us what your target is, and your target might be a net target, in which case explain the net target. But from an impact point of view, sort of mitigation hierarchy point of view, it's reductions that matter. And moreover, so it's actually reducing your own emissions and minimizing the gross emissions that matters. And the offset is a separate process. It's not something you can offset in an accounting sense to get to a net position. The reductions come from a different place. They're not part of the product footprint. They can be used in aggregate to reduce the overall emissions, but I think it's inappropriate to apply them in a product costing approach. So final comments. I'm up on time, slightly over on time. But, so
did you just say 5 more minutes?
No, I didn't say 5 minutes. I said
that would be bold.
I wouldn't dare do that to you, Ndidi. So in summary, I think there's a distinction between rules for reporting and practice of management accounting. I think an accounting approach focusing on control of net assets takes you away from thinking about downstream, and that's problematic. An accounting approach which in effect is measuring dependency and financial performance is a measure of financial effects on investors, whereas the focus here primarily is impact on the environment, which is impact, not dependency. An accounting focus on measurement over estimation, I think, draws you away from impact, which is also inappropriate for thinking about impact accounting. And the double entry mechanism of amortizing and netting, I think, also takes you away from measuring impact. I'm going to stop there.
That's excellent feedback. I can see Professor Reichelstein taking notes avidly. And now I hand over to you, Michael, who is very focused on methodology. And, I'm very keen to hear what you have as feedback.
So first of all, congrats to that paper. I think it's like terrific work and really sparking a lot of ideas in this room also. So many thanks for that. I think one of the key benefits here, and I fully agree that we need some general accounting principles. I think like comparability was something that came up like so many times already. And that's specifically true when we're talking about like the specific measurement of carbon emissions as like one of the metrics that we're interested in. I really also have to say, I really appreciate that you're like building on a concept that is around within the accounting community. So it's easy to understand what we're doing here. I think that's like one of the key benefits actually. But I also feel similarly that's like, even though like this idea of like one is like measurement, one is estimation when we're talking about own operations upstream versus downstream, I think in practice often that's just not yet the case. So often we're like, especially also when we're talking about upstream, there's like so many estimates involved in that, and even though there might be like some big companies able to really like go into this practice, there will be a lot that will base their like upstream emissions on estimates still. So I think that's something that we just need to acknowledge, and it's not like just measurement versus estimation in that sense. I similarly feel that by ignoring the downstream impacts, or not ignoring, that's like the wrong word maybe, but like by not having that in the same language and on the same level as the upstream scope 3 emissions, that really might incentivize a different way of like also product design. I really like that it's like so product focused, because it's really getting us where like we can find the carbon emissions in the end. Like it's always related to the product. It's either like somewhat that produces it that is like causing it, but it's always related to the product. So it's really helpful to have that. But the moment we just, especially when we're talking about management accounting and like product design, that's one of the reasons why the GHG protocol has that involved, like the scope 3 downstream, because you need to think about that also in your product designs, like to really like move forward in that. In addition to that, I think there's many things that you have brought up already, which is like not only like the measurements and the estimation, but really like also like who's able to do that. Maybe also I would like to like really highlight again. I think we see at the moment that there's already a lot of struggle in big companies, in like the ones that have the resources to actually like implement it at this point in time, but to like implement that system like then for small companies might be a challenge. So really like the estimation problem will probably keep us quite busy for a long period of time. One other aspect, and that's like something that of course you mentioned, that I'm like developing methodologies which not necessarily only relate to carbon. I think it's a nice way of thinking about this, maybe even beyond carbon. Like, so how does it actually connect to other topics? We will hear about biodiversity. We will hear about like, or we have heard about social topics, and an accounting system that's like actually like works for carbon might be also helpful to like guide us in a way that we are like actually like also looking at other topics similarly. Mm-hmm. So that's like something that I just wanted to highlight again, that this might be something worth exploring, also just like expanding that.
And I think the reason why we had, and I think we're already seeing the success of this consortium, the reason why this consortium and this initiative was signed up, so that we can actually take theory into practice. And I understand that actually BASF, possibly a few others, are in the room who are actually implementing this methodology that you have. I think you've heard some pushback, especially from Richard, on some of the ideas, especially regarding impact. I don't know whether you want to give a first stab at a response, bearing in mind we have 9 minutes to go.
9 minutes for the whole thing?
For the whole thing.
All right. All right.
So you can't take
then
all the 9 minutes.
I will have to choose. Perhaps the whole question of if impact is of a product is really measured both in the generation production phase and in the use phase. I totally agree with that, but I hope I sort of conveyed from an accounting perspective, it is really the production phase that in principle can be measured and verified. That's an important advantage. What happens in the use phase will by its very nature have to be an estimate at the time that the goods and services are leaving at your gate. You mentioned oil and gas as one example. That's, in my mind, not an appropriate example where things can be measured. If that gas is ultimately used in combustion and generating electricity with a carbon capture facility, the emissions of it are totally in question. What is the impact of the gas? Well, that depends what the buyer does with it. When I sell you an airplane, the emissions in the use phase depend on how this airliner is being flown. It depends on whether we're using a sustainable aviation fuel or traditional fuel. I cannot possibly tell you for certain at the time that it leaves my gate what the emissions are with it. And then I would say, as an accountant, as accountants, it behooves us to make that principal distinction explicit in the books. Nothing prevents you from adding an estimate of what we think our product is going to require in emissions. And I'm entirely with you in certain industries. So there's, by the way, for those of you who teach this stuff, there's a lovely new case by Harvard Business School out called Driving Decarbonization at BMW. Cute title, I know. But BMW will make the point. We are, of course, taking this very seriously. They would like to make that point. And electrification is going to be a key way in which we are designing and selling products that are contributing to the decarbonization process. If you only did what I showed you here, upstream scope 3, electric vehicles don't look particularly good. Why? Because the manufacture of batteries is highly energy intensive and a lot of emissions are associated with it. So BMW will tell you, if we want to show to our customers and to the world at large the progress we're making, we better add some estimates, but they're also very explicit. These are estimates that depend a great deal on where in the world this car is being driven. In particular, the EV it can be driven in a country like France that has a clean grid, or it can be driven in China, and that makes a world of difference. So all of that granted, and for that reason, really a full scope 3 analysis is desirable, but all I'm really saying is separate that out cleanly and make clear that the front part is measurable and verifiable. The end part, the end use part, that remains an estimate item.
So one of the things I hear you say very clearly is, I hear an endorsement, I don't know whether you hear it, Richard, of the fact that we made or recommend scope 3 to be mandatory on the one hand. On the other hand, I also hear very strongly that there is a distinction and a variance between industries that needs to be carefully paid attention to. Again, from that perspective, very glad, and building on what Emmanuel said earlier on today, that there is quite a bit of dialogue between ESRS and the ISSB, and of course GRI, on sector-specific metrics, which speaks to that. I just want, and then the third thing I heard you say just now is how important it is that we have standards. There's a bit of a conflict between you and your general accounting carbon principles and Richard's negative feedback on that, it not being sufficient. I don't know what your point was. I don't think you spoke to that specifically. I think you were more endorsing. And in the last 4 minutes, I wonder whether there would be, I had hoped that I could open the floor to a few questions, but I don't think we can. So I think I'm going to close with, unless there is one burning question, and that will create the closing statement. Any core, fundamental, basic comment, question? No. So my core question would be, where do we go from here? How do we take this very important paper, very important idea, very important initiative, and actually fast track scope 3 in particular, so that it can be used, and so we do have a standard that we're working on?
I think it's happening. It's happening in a number of industries, unfortunately, and with a number of companies that sort of we have followed. Unfortunately, it's not yet happening in a way where you would say they're sort of playing by the same rule book in doing some of the calculations. Certain principles, I think, are becoming clear in terms of stocks and flows and things flowing through. In particular, that you are in principle adding up all the scope 1 emissions along your entire supply chain, so that at the end of the day, these are the cumulative scope 1 emissions that went into things. That's relatively easy. That's sort of a balancing or an adding up requirement. Where things differ, and I mentioned earlier Catena X and Together for Sustainability, these are examples where some players and some companies in these industries are saying, given the nature of the operations and the production process we have, we need to be a little more detailed in terms of really setting standards of how to calculate these product carbon footprints. As both of the discussants pointed out, by its nature, that gives you a certain amount of discretion. And I think that the tough part going forward is going to be, to what extent do we want to delegate this flexibility to companies to say, this works for us. It captures the cause of the emissions and the effect on the products. If it does that ideally, then great. But on the other hand, you do worry about manipulation and you worry about lack of comparability at the end of the day. I think where that balance comes down, that is still to be decided in the years to come.
So maybe that's what we can ask the discussants in 1 minute to close on. Where is the balance? How do we find that balance? What are your thoughts on that?
I think that's really like a difficult one. So I have to say, like, one part is you mentioned, like, really, like, also like to like take the product view in many of these things to like really understand the interconnection here. But I have to say, like, especially when it comes to the calculation and the use of that, we probably need to like also enable like the user of that information also to really like get more contextualized information. So really like going just beyond a product footprint in that sense, but really understanding what does the product footprint actually do, to really like make use of that information also. And this contextualization, I think, will be like a key next step also in that journey.
Excellent.
Just one very general comment. I mean, the single most important feedback that we had from our agenda consultation process was the need to implement and to help the market implement S1 and S2. And these are precisely the kind of issues that need to be mainstreamed in thinking about implementing S2.
I think that's a great, excellent way to end. I would like to give a great round of applause to this panel. And if size of papers is anything to go by, the next paper, and I would like to invite my speakers up on stage already, is 120 pages. I'll say it so that you don't have to say it. And it's really, so we're moving now from the biodiversity, from the carbon footprint, corporate carbon footprint, we're moving to the biodiversity carbon footprint. I don't know whether you have slides.
I have slides.
Excellent. So can the slides please go up? And you're very welcome.
Thanks.
I'd like to invite to the stage my panelists, and I'm giving the floor to you immediately.
Super.
So we optimize time for speaking. I think we're just missing Michael Schmidt, who is going to come up in a second.
Yeah, he's been wired up. I think we get going
yes,
right
go
away.
ahead.
Maybe you give me a 5-minute signal, 5 minutes before I should end.
Go ahead.
That would be good. All right. Good afternoon, everybody. Thank you for having me here. It's a great pleasure to talk here in this room. It's been an exciting morning already. I'll be talking about biodiversity, and I don't think I need to define it, but I think it's still a good idea to start off by saying what we mean by biodiversity. So it's the variety of living organisms. Why do we care about it? Because biodiversity provides certain services, ecosystem services. So this morning, I hope you've had an apple. An apple a day keeps the doctor away. An apple doesn't come from a supermarket, it comes from a tree. And most trees need pollination. There are some self-pollinating ones, but those are the rare exception. Pollination needs to happen through bees, for example. And so we need a certain degree of biodiversity. Similarly, if you've ever used medicine, it's likely that a pharmaceutical company was tapping into the genius of nature to create that pharmaceutical product. Or also corals. They're not only there because it's so nice to snorkel around in them, but also because they protect against floods. Those are all kinds of services that the ecosystem provides. And the World Economic Forum, and I usually don't cite consultants, but in this case, it's a good study. The World Economic Forum estimates that between half or even more of world GDP depends very strongly on these ecosystem services. Okay, so and central bankers have also started worrying about the loss of biodiversity as perhaps being relevant for our markets overall. In fact, I wanted to share this picture here also in light of something that we discussed this morning, or that the panel discussed this morning, in terms of priorities and potential trade-offs between topics. This comes from studies published in Nature and Science. So these are arguably pretty good scientific studies that looked at the concept of so-called planetary boundaries. So these are, you can think of them as tipping points. These are elements of our planet that, if lost, really create massive difficulties for other systems, and we really shouldn't cross those boundaries. The boundaries are set before the tipping point, because if you get to the tipping point, of a system, it's already too late. Notice the years when these studies were published. At that time, climate change, featured at the top, was considered to be still in the zone of uncertainty. We've moved beyond that. But notice, genetic diversity was already seen as an area, a planetary boundary, where we have already crossed the zone of uncertainty. So talk about priorities here. Amazingly, there are thousands of papers, literally, academic papers in finance and economics that deal with how climate is being considered in financial markets. Grand entrance. There's basically nothing out there on the topic of biodiversity and financial markets. And so this paper is a first step in changing that. That was motivated by developments in the policy space. I think I'm not telling you news here. You probably have followed this, but it's good to set the stage. In October 2021, the Kunming Declaration was signed, not actually physically in Kunming, that was online. It's basically the equivalent of the Paris Agreement for biodiversity. So besides the COP meetings, the Conference of Party meetings for climate, there's also been COP meetings for biodiversity. They've received less attention, but in the light of what I just told you about the importance of biodiversity, they're arguably pretty important. And similarly, like we have the TCFD, we have the TNFD. The difference is this is moving much faster. For example, Norges Bank Investment Management, one of the largest asset owners in the world, is a founding partner from the get-go of TNFD. They only came on board for TCFD much later. Okay, so there's a lot of movement in this space. Nobody knows where this is going to be going. So it seems like it's an important topic, but there's great uncertainty about it. Now, uncertainty is something that financial markets hate. And that's where our paper with the first step comes in. I cannot emphasize enough how early this step is. So there's lots of things one can and should do in this area. We are interested in this paper in the question whether the market has begun to price a risk premium for regulatory developments in the biodiversity space. So the idea is, if you are a company, if you're running a company that has a large negative footprint on the world in terms of biodiversity, then you are at higher risk of litigation, regulatory action, reputational damage. Okay, just because there's this huge impact of the firm on the world and from the biodiversity back to the companies, you are arguably exposed to greater risks now than you were just 2 years ago because of these regulatory developments, Kunming being one, TNFD being one. Classic asset pricing theory, I'm not going to bother you too much with that, but for example, the Pastor-Veronese study at the top, which has nothing to do with climate or biodiversity, classic asset pricing theory predicts, well, when such regulatory uncertainty increases, investors begin to demand a risk premium, or they demand higher cost of capital from companies. And what happens in theory is, at the time when this regulation uncertainty increases, stock prices drop for the firms that are most heavily affected. And going forward, these companies then have to deliver on that. They actually have to deliver these greater returns. So you have this double effect, which is going to play a big role in my presentation. And I realize I have a very diverse audience, so I want to emphasize this logic of, if a regulatory uncertainty arises, you get an immediate drop of the firms that are arguably most affected by it, but then they're going to have higher returns to compensate investors for keeping holding them. Okay, so that's the theory here. And we're trying to get at this. And for that, we need a measure of the corporate biodiversity footprint. And then we're going to try to see how it actually relates to stock returns. Now, there's very little research, but there's an emerging literature. And it's really amazing. It's crazy. If you look at the importance of the topic, I don't quite understand, other than that it's been hard to measure anything, why the literature has kind of sidestepped it. But fortunately, we've sort of broken the curse now. This paper is forthcoming in one of our so-called leading journals. There is a few other things which are also cited in our paper, and I hope more is developing in this space. I don't have time to go into them. I just didn't want to get the impression that nobody else is working on it. There's some very smart people on this. There's two features I need to talk about. One is this footprint idea, and I'm actually going to spend most of the time on that because the measurement of the relation to stock return really makes sense if you kind of understand what goes into this footprint. And then I'm going to show you the results related to stock returns. So 5 minutes on the footprint. The idea here is we use something provided by a company called Iceberg Data Lab. This is measuring the footprint of companies in terms of so-called mean species abundance square kilometers. So you can read the definition down here yourself faster than I can talk about it. The basic idea is with all the activities of a company, the data provider tries to go through what is the impact of a company in each of the places where they are active on the local biodiversity and tries to aggregate it up onto one component, to one number. As you can imagine, that's a highly challenging, a very difficult process. And I want to give you a sense of how they do that in terms of steps using one company, which at least some people in the room here know a whole lot about. But in general, the approach is mapping each activity of a company into so-called commodities, then translating that into a pressure using an input-output model, and finally into impact. Those are sort of the terminologies here. Importantly, this is done in scope 1, 2, and 3. So the important idea is here to have the full value chain. And the company where we got a lot of information by chance from, I obviously didn't know that I would be presenting this here, but this company is well known. The company where we got the data from, also because they disclose a lot on it, is Nnoli, or Danone, as it's called in the United States. So Danone had revenues of 20 billion euros in 2021. Out of that, about 2 billion, come from operations of dairies and cheese making in the United States. Now, to make cheese and dairies, you need cow milk and other kinds of milk. For example, it's estimated through this input-output matrix that's behind this. This octopus at the top is the input-output matrix. You need about 2 million tons of milk. Now, to get to milk, Danone doesn't have any own cows, as far as I know. They source the milk from farmers. Cows grazing have an impact on farmland. It's land use, one of the primary elements of biodiversity impact. You need about 13 square kilometers of farmland to get to 1,000 tons of cow milk on average worldwide, a bit more in Europe than in the US, so that's all taken into account. And that results into a pressure. I'm really short-circuiting a lot of technicalities here because I don't have the time, but the basic idea is it creates a pressure, an ongoing occupational pressure on the land where the cows are grazing. And so at the end of the day, if you aggregate up country by sector across the world of all activities of this company and of thousands of other companies, it's a massive data collection effort, you get to an impact of a CBF, the corporate biodiversity footprint, in this case of around 10,000 square kilometers CBF. So that does not mean that this company sort of destroys biodiversity on that scale every year. It's the ongoing pressure that's being exerted rather than having the biodiversity coming back. Just let me be very clear on that. The other dimensions that this measure looks at include, for example, nitrogen that goes into the land, the soil, or also greenhouse gas emissions. It does not consider, for example, marine biodiversity, which is a very important element, but there's simply no measurement we know about it in this space yet. There's other features or parts of this measure. And I want to be very clear about this. First of all, we don't earn any commission on that measure. And second, there's a lot of stuff that one can and should do, maybe do better. For example, it's not, and we discussed this in the paper in more detail, if you're interested. It's not looking at the importance of any given species. I've presented this to ecosystem researchers at the University of Zurich also, and I've learned, well, some rare species are very important because they allow systems to be resilient and come back. That's not accounted for. Second, the Globio model, which sort of has the underlying impact pressure functions, is pretty old and has been questioned. Third, Some pressures are completely neglected. And finally, amongst other deficiencies, we are not really interested in the mean species abundance per se. We are interested in the services that are being provided. So that's yet one level deeper, not accounted for here. Okay? And there are alternatives. We discussed them in the paper also, but the feature, the fact of the nature is right now, this measure is in some sense the best we could get for a large sample of companies where we wanted to do the study. But it's a call to action for researchers to come up with better measures to really get at this. It's a widely used measure. I also want to point out, maybe I can jump ahead to this. It features in the TNFD documents, so it's recognized there. It's used by a wide range of institutional investors. This measure that we use here, the corporate biodiversity footprint. So for example, AXA uses it, BNP Paribas use it, and so on and so forth. You have them listed here. It also correlates pretty strongly with where Nature Action 100 got going. You may have followed, that's kind of the equivalent to the Climate Action 100, targeting what they perceive as the largest biodiversity impact companies. It correlates very strongly with the measure we employ here of the corporate biodiversity footprint. So yeah, probably there are some problems with this measure, but it seems to be something that investors do care about as they talk about it. Now the question is, do they care about it to an extent that they're actually putting money on it one way or another? Okay, so now we need to talk about what's the relationship to biodiversity returns. Super, thank you. By the way, as a side note, I'm a big fan in other work. I do a lot of textual analysis, so using algorithms to get at what disclosures say. In biodiversity, you can't do a whole lot on that. We tried, but very few firms actually disclose anything related to it directly at the moment. I suppose this is going to change, but historically, very few firms have. Second part, stock returns. And I only need 4 minutes for that because the analysis is actually pretty simple once one understands or at least has a feeling for what measure we are using. Just to remind you, we do dual analysis. And I know to my corporate finance and asset pricing friends in the room, we think that's a minor selling point of this paper to have the duality, both an event study and the long run returns looking forward. So we expect, on the one hand, firms with a large footprint to drop when there's a negative in an event, a regulatory event, like Kunming, and we expect them to deliver higher returns going forward after as a risk premium. We find exactly that. So maybe let me first show you around the Kunming declaration. So, this looks maybe a bit funky, but it's actually a relatively clean event. The Kunming declaration, it was very uncertain whether we would find an agreement. People were walking out, delegations were walking out, coming back in. In the middle of the night, there was the news, yeah, we have an agreement. Nothing specific, that's the point. It's uncertain what will come of it, but there was an agreement that something would happen. And around that time, falling forward, firms with a large footprint dropped around 1 percentage point, which is a whole lot relative to what other events of this magnitude do. In terms of realized longer run returns, there's a long table with control variables and lots of robustness tests, in particular also accounting for the carbon footprint of a firm, carbon risk exposure, and so on and so forth. After the Kunming declaration, stocks with a large footprint delivered larger returns. So you can't interpret these numbers right now. So I wrote down the quantitative interpretation here. If you compare two otherwise identical firms, a firm with a footprint 1 standard deviation above the average had higher returns by about 2 percentage points. So that's a pretty large differential. And we provide some tests in the paper that suggest that this can actually be interpreted as a cost of capital effect. So here it gets a bit more technical. We need to get into the difference between realized and expected returns, and we do all that. But I think for this audience, I'll just leave it at the general summary statement that we can interpret it as the market is beginning to price the risk premium here. So let me conclude. So a bunch of robustness checks and interpretation. We have not only the climate crisis, but we do need to think about biodiversity. They're related in complex ways. They interact with each other, but that shouldn't keep us from thinking about them also clearly and separately, because otherwise it gets all confusing. Our paper, which is just the beginning, seems to suggest that a biodiversity risk premium has emerged. So the title question is, do investors care about biodiversity? You can answer that in a nasty way and saying, well, they didn't really care until they were prompted by regulation and the TNFD to start caring about it. But now the answer is, yeah, they do care indirectly through this risk factor that I've explained. We hope that's going to be relevant. So I'm speaking here to my macro friends, to policymakers, clearly disclosure standard setters, as we are talking about here. I hope that researchers in ecosystem services will also take this as inspiration to say, hey, look, these finance guys, they need something better. Let's work something out on that. And then finally, for managers, I've also had a chance to talk to some managers about disclosure questions. They need to learn about this topic first before they can even start thinking about disclosure. So thank you very much for having me here, and I look forward to the discussions in plural. Thank you.
Thank you, Professor Alexander Wagner, for this excellent paper. I'm looking directly to you, Professor Katrin. Go ahead.
Yeah, thank you very much for inviting me here to discuss this paper. It's the very first time I'm doing this kind of thing. In our community, we just don't discuss papers in scientific community or in general in the public. So it's a very thrilling situation I'm finding myself here. So I was asked to first provide a positive reflection of the paper, and I think indeed it is really exciting because, in my opinion, it's the best and most concrete marriage between biodiversity and the finance sector I'm seeing. So where I, as a biodiversity researcher, actually see how the data we are developing, and I'm a macroecologist, so I've been doing this kind of research for more than 25 years, both on a macro scale, working globally, and on a very concrete scale, going in the field and seeing how human impact is influencing ecosystems and ecological communities, how the data we are assembling are brought together with data from the finance sector. And please, I'm apologizing ahead if I'm using the wrong terms. The language is very different from ours, but I think I can at least broadly tell how I interpret this. So I think it's a wonderful first step, and it's very inspiring also to the biodiversity community. And from our perspective, from my perspective, I see three challenges that need to be addressed both in the biodiversity and in the finance community. And that is, first is about the biodiversity footprint indices. The second is about the pressures we are dealing with. And the third is about the risks we are dealing with. And you took the mean species abundance index. We know that it is the most widely available index. It has some really severe challenges, and I, as a community ecologist and macroecologist, would actually judge it to be a really bad index, and for basically two reasons. First of all, it's comparing the abundance of species in general from a site I'm looking at with a benchmark site like a healthy forest, and see how it means species abundance has changed. And in this analysis, I'm treating all species equally, which is, again, a bad approach, because if we want to protect biodiversity, we're looking mostly at threatened species, so the threatened species should be taken more seriously. And that's also something that should matter to firms, because if the one species that is declining in my site happens to be a charismatic species, which is receiving a lot of media attention, like the orangutan, the decline of this species is mattering much more than if you have a decline of house mice or something like that. The second reason we are protecting biodiversity is for the ecosystem functioning. And here maybe the orangutan is not very important, but the community of monkeys that is dispersing seeds and contributing to the regeneration of a forest is important. So we should look at the identity of the species that are in this index. And there are better indices emerging, and it's basically a plea to the own community to work on this and to develop better indices. The second problem is, and that's again a big challenge, is that the pressures that are causing a decline of biodiversity are in this index merged together. It's land use and it's greenhouse gas emissions and air and water pollution. And these types of pressures work very differently. If we have a tropical forest and turn it into a soybean plantation, and this is a really severe impact on the local and regional biodiversity, loss of threatened species, loss of ecosystem functions of this forest. So land use change is basically the most severe pressure we are seeing in biodiversity research, whereas the carbon footprint of this forest, I mean, probably the CO2 level is increasing by turning the forest into a soybean plantation, but the impact of this increased CO2 emissions is tiny, and it probably happens somewhere else on Earth, maybe to the polar bear at the other side of the Earth. So if we basically need to keep these pressures differently, it's not only comparing apples and oranges here, it's really mixing different types of pressures. So for the pressures, we now have consensus, and we have something like the IPCC also in biodiversity research now, the IPBES, the World Biodiversity Council. If we look at impact on biodiversity, factor one is land use change, land use change, land use change, and then comes exploitation of species, which is mostly happening in marine systems, fishing, but also on land, like bushmeat hunting, very severe threat to tropical biodiversity. And then there's a gap, and then there comes climate change, and then a further gap, and then there's pollution and exotic species. So we need to look more closely at the pressures and distinguish between the more important pressures and the less important pressures. And finally, the risks. The effect you found, as far as I understood it, is that companies with a big footprint face a big transition risk, which is then considered with a premium. However, we in biodiversity research see or think a different type of risk should be much more relevant to firms. And that's because of the loss of biodiversity, ecosystem services are declining. So we are losing pollination services. We are losing the natural regeneration of forests. Soil fertility might go down. We are losing natural biological pest control. We might have losses in the quantity and quality of water, or all kinds of assets are getting damaged because of floods and landslides, because the protective forests and the mangroves are gone. And that is a different type of risks that is much more difficult to measure than the footprint, in fact. And that is probably something that we have to study together to see how ecological services can be put into measurements that are then tangible and measurable also to firms. I guess in general, I think we need to be more smart in what kind of pressures we address, what kind of firms we take into account, because if the main thing about biodiversity is land and land use change, we probably need to start with firms that are in the food sector, that are in the forest and paper sector, textiles, and fisheries, because they, as a group, will have the highest impact on biodiversity, but also by different kinds of business models and the way they produce, they can have also the biggest positive effect on biodiversity. So by starting from basically the big drivers and looking at the big effects, we might really get a step forward. So in general, we need to collaborate more, and I think the paper is a wonderful starting point. Thank you.
Thank you, Professor. Professor Böhning-Gaese, I think your passion comes through very clearly. And I think it also highlights the reason why it's so important to engage with academia. And the interesting thing on this panel is that we now have somebody who is from a very practical investment asset management world. And over to you, Michael Schmidt.
Well, thank you. And I find this all rather fascinating, I have to say, because it's very rare that natural scientists, particularly of that kind of researchers and investment people or capital markets people, speak with each other or speak about the same topic at least. And I would have said this as a disclaimer: I'm not an academic, I'm not a researcher, I'm not a natural scientist. I look at it as a practitioner. And when I look at this paper, I would like to thank you very much, Alexander, for bringing this out, really, doing the analysis, because it's one of the first attempts at trying to make biodiversity, or show how biodiversity is or can be relevant in financial markets. One has to say, investors, my investor peers and analyst peers have really little idea how to grasp biodiversity in their financial decision making. So I'd like to really thank you for that. And what you highlighted are two findings from my perspective that are very interesting and very relevant. One is, you basically, over the whole period, which is a short one, which is a criticism, a short period, you show there's actually no correlation, or there's no relevance. Let's put it this way. But when an important news, a potential valuation relevant news hits the screen, as it did with Kunming and with TNFD, suddenly there's a reaction in the share prices. And so this tells me when and if and when there is attention and awareness in the market for valuation relevant factors, and it seems biodiversity has come into this kind of thinking, then there is a reaction. But as you show, there's no long-term relation, essentially. It tells me the awareness and the attention is very limited to around these events, and not necessarily followed up on. This tallies quite nicely actually with my experience as an investor over 30 years in analyzing and investing in stocks. When you have an information that hits the screen, and you think this must be somehow, because of the news flow around, somehow valuation relevant, the first reaction is to discount it in your valuation, rather than trying to assess the exact cash flow or balance sheet impacts, because you have the uncertainty. So your risk premium analysis, which is corroborated, is quite natural for things that are still very unclear, uncertain, out in the open. They could, however, then lead to cash flow relevant news as well, which is the factor in your analysis, you basically excluded or said this is not a cash flow event news. It wasn't exactly, but actually the risk premium discount, the risk premium effect, so the share price drop that creates the risk premium or reflects that there is a higher risk premium, is only the precursor to behavior that could follow later, i.e. either cash flow relevant news, or the investor preference, your third one you looked at. So this fits very well with where we stand actually on biodiversity. Biodiversity is an uncertain valuation factor that we cannot grasp really in the market, but we somehow feel it is relevant. So from that perspective, I know why you made this artificial, I call it artificial distinction between risk premium and then cash flow factors and then later investor preferences. For me, they are not completely separate or they are interrelated. So one criticism was the short time frame. I said already. I think also this interdependence of the relevant of these effects or these motives for the reaction of share prices or the analysis of returns, I think is a bit artificial. So they are interrelated. The methodology actually of MSA, I have no idea what it is about really, to be honest. But we heard Katrin, and I talked to someone else who looks at it from actually someone from WWF who shares your view on the utility of this measure. I can only tell you from a market perspective in financial markets, I don't precisely care as much. I'd like to get some outside approval that it actually is the right measure or a kind of right measure to look at, because we don't know better in the financial market, simply as that. But it seems that even this poor measure does have an effect. So I think the methodology needs to evolve. And just a last critical point before I sort of look at the implications what we should make of your research. When you talk about risk premium, please don't put in practice. I mean, you said it in various other throughout the paper. You made it clear what it means. But in the abstract, you say this is higher returns, risk premium, i.e. in brackets, higher returns. It's not higher returns per se, it's higher return expectations or a higher return demand. So I just want you to be really accurate about what the risk premium means. It's the higher return expectations. It does not necessarily result into higher returns. So what do we make of this looking forward? For me, this is testament to biodiversity is not only a potentially, but is a relevant factor in making financial decisions and in valuation. However, the news effect of it tends to fade if I don't have a follow-up. I make an example where you also have some uncertainty around things. So some regulation may come up, like the one we debate in Europe is the 2035 end of the combustion engine. So this is a regulatory event which is still a bit uncertain, but it will make a difference, of course. So addressing that is also a risk premium event, I would say. But then there's follow-up. I will hear more about it. I can actually do my modeling. I can say, okay, after 2035, the cash flows of combustion engine producers will be truncated. So I can do more of the analysis. With the TNFD events you mentioned, I can't see where the follow-up really has been in terms of tangible results in terms of companies reporting. And you mentioned precisely your textual analysis does not work because you have little talk about by companies about biodiversity. So what this means is it is relevant. We have little information. Investors should care about it. We need more disclosure on biodiversity, more relevant disclosure, not per se disclosure. That's why I commend the work of TNFD and of course the ISSB in this part and ESRS. So this is my summary. We need more information in the financial market to make it more persistent for biodiversity to be taken in as a valuation factor that is relevant.
Thank you so much, Michael. I want to acknowledge that SAFE put together these two panels. It's very fascinating for me. because we're coming much closer to exactly what's on that board, better information for better decisions. And it's really very, I was very curious as to responses and also very impressed by the paper. Do investors care about biodiversity? And I think what we're hearing is, yes, they should, and they do, indeed, the world should, but we need to measure better. We need better information. And I love the fact that the terminology risks keeps coming up. And what you've just said, Michael, we need relevant disclosures. We call it material disclosures. What I also note is the distinction between the three different perspectives and how nuanced they are. And actually what we need to do is we need to find a way of marrying them all together. We have very little time left, 6 minutes. And Alexander, I can see you have lots of notes. So I'm going to give you 4 minutes.
That's perfectly fine. Thank you very much for making it through the paper. And I was joking with Katrin before when she told me she had never done a discussion. I told her that's the part where usually people in the audience get out the popcorn and they have fun. So this was one of the most mellow discussions you will ever hear in a finance conference. So it's basically a hymn on the paper. So thank you very much for being so fantastically positive about it. So as the paper is published, we can't do much about it directly in it, but there are several points that I do want to pick up. First, focus on industries. It is very important to understand, I think, and it's one of the things I learned, there's a lot of variation within industries. So the pure industry focus you would get from an Encore framework or from a biodiversity impact assessment framework as it stands now, it's unlikely to get at what we really want, unless we are happy to take a first step. Second, the fourth biggest impact industry in our sample is the asset management industry. Okay, and that's because they provide funds to companies. So it's a scope 3 dimension. So focusing from the get-go on food or agriculture, so it's probably you can do it, but then you're eliminating part of the appeal of this multi-layered measure. I thought it intriguing. I'm just picking a few points right now because there was a lot of rich information here. I thought the point, it could lead to cash flow news. That's a very intriguing idea. Now, I want to briefly elaborate on it. The cool thing about the financial market, I don't know if anybody in here needs to be sold on the advantages of financial markets, but the cool thing is they provide information. It's a crystal ball. They teach us something. And what they teach us in this case is, well, it could be that investors expect with Kunming and TNFD that it will be more costly for firms to have large biodiversity impact and thus lower cash flows in the future. That could be, but then we wouldn't be seeing this increase in returns for those companies in the period after Kunming. Right? You can explain the drop in stock prices around the event, but you can't explain the longer run returns with it. So as is right now, the financial market is talking to us and is saying in the sample period, at least it's limited. There's more of this risk concern rather than the cash flow concern, but that's to be developed further. Maybe the final point I could briefly address. When I presented it the first time to the biodiversity researchers at Zurich, and I started talking, and I said, well, we're using a measure that starts, with the MSA. They almost, left me out of the room effectively in the first sentence. And then I posed a simple, and actually one of the very, very well-regarded professors there, I'm not going to name his name, said, it's very easy to construct a measure of the biodiversity impact of a company. And then I said, okay, can we do that for 2,000 companies for 4 years, please? We continue talking about MSA as the measure, because simply at this point, that's what it is. So I can only reiterate as an outcome of this panel, maybe the need for the collaboration between industry, the scientific, actual scientific hard sciences community, and the social and economic sciences to advance this cause. Thanks.
And I would want
Alexander, if I can add, what this tells you is we in the financial market, we just take what there is.
Yeah, but what else should you take?
Information,
I mean, right? I mean,
and we make our guesses.
Yeah, I used to do that. I was a trader once, so I know a little. I know a little bit about how financial markets work.
That's a good add-on. And I think that what we should actually do is we should make sure, I think the great news is that what we heard from the market, the 400 consultation comment letters feedback, was that the most important thing that we should focus on next is biodiversity, ecosystem, and ecosystem services. So I'm pretty sure that perhaps what we should do is have another of this panel discussion, perhaps with a little bit more time, and also invite the previous panel. So let me close this panel by saying thank you, SAFE. Thank you for actually convening this, both of the panels so far, and be assured that this will definitely feed into what we do going forward. I'm going to let one last round, closing statements, because we do have a tea break, and if the room will allow me, then, and I would love for you to answer the question, what do we need to do to ensure that this kind of work is mainstreamed, and so that it actually very quickly moves into clearly what needs to be a risk and opportunity for businesses, for the corporate world, and for the financial sector, for investors, and therefore for the planet at large. And I'll start with my most passionate panelist.
Yeah, the obvious, the biodiversity community has to get themselves together and develop better indices that work over space along whole supply chains and that work over time so that you can actually monitor also changes and differences. And what I also think, and it reflects what you have shown for the carbon market, we probably need to spend much more thinking in offsets and biodiversity credits, and right from the start, develop systems that are scientifically evidence-based and robust, that then also provide another way of improving biodiversity, restoration, ecosystem revitalization are big issues right now that could be a huge market and that could actually bend the curve of biodiversity loss. And we should make it better than the carbon community.
Aha. So what I am going to do actually is I'm going to ask Florian, I'm going to actually ask somebody to capture the team, this team and this team. It's break time, so everybody else can go for break, and they have to line up here in one long queue so that we know that we're taking this discussion out of this room into practice. So that in a year's time, perhaps when we have this conference, we want to know how far you've gone and how far you've gone in terms of mainstreaming this and making it practical. And maybe we'll then have a panel of investors who are confirming that this is much more mainstream and useful and practical in terms of evaluating risks and making investment decisions. Is that a deal?
Deal. But
I just need
if the Deutsche Bahn works better, then yeah, I'll come.
To bring it in the financial community, I need a 3-page PowerPoint summary.
Okay, please note, because you were worse. This is 120 pages. That was 45 pages. So it's actually the inverse.
You can talk to the referees if you want. Okay. So.
I would like to thank very much my panelists for this excellent session. We kept to time, incredibly so, and a very, very rich discussion. Thank you so very much.